As one of the most anticipated and exciting ETFs since its filing and then now to the actual release, the reaction has been overwhelming for HHIS. In this video, we'll go over all the details we know so far, and then try to draw some conclusions on some of the questions that still remain. This is mainly surrounding the monthly variable distributions going forward, and after crunching some numbers, I think I have a guess as to what it all means. So if you enjoy this type of content and want to help support the channel, feel free to subscribe and give the video a thumbs up. Okay, let's get into the review of HHIS. So after the release of Harvest's initial high income shares products in August of 2024, it has renewed some of the interest for single stock ETFs in Canada. In the US, there are already a growing number and many popular products released primarily by the YieldMax fund. But in Canada, we haven't had the same degree of releases in this area, and especially with the super high yields. Purpose Investments has actually launched a lineup of single stock ETF products back in 2022 at the end of December called Yield Shares. The most popular of which is Tesla with the ticker symbol YTSL, and targets an approximate 20% yield. Because of the high yield, it has been a part of many passive income portfolios, myself included, that wanted the income but also growth which followed the underlying stock very closely. Some of the other products also released at that time in Google, Amazon, Apple, and Berkshire Hathaway are a bit mixed in terms of popularity, and I would say are more niche options. Over time, as YieldMax continued to grow in the US, it's now primed Canadian investors wanting those high-yielding products here in Canada as well. So it's not too much of a surprise that even some of the tickers Harvest has selected are exactly the same as the most popular YieldMax ETFs in MSTY, CONY, and TESLE in order to possibly draw together the similarities. But it's important to note that the strategies employed by both of these funds are entirely different from one another, and it should not be confused or to have the same expectations based on the US versions. Now getting back to the news release, one ETF in particular that likely caught the attention of everyone was their all-in-one ETF, which will be under the ticker symbol HHIS. Without much else in terms of details, it was expected that it will hold all the existing high income shares products, along with the new ones that were announced alongside HHIS. These all-in-ones have become a popular request by investors, and makes sense for funds to group the existing single stock ones into a basket of stocks for the convenience and diversification. With the initial holdings, it makes this a bit of a unique fund, where the first 9 underlying holdings are focused primarily on tech, AI, and crypto, but then it also includes Eli Lilly as well for some healthcare exposure. The criteria for choosing these underlying stocks was based on them being large cap popular names and widely held companies with vast options markets. They also have great growth potential as well going forward in the coming years, so investors can also expect to participate in the eventual upside over time. A lot of these details I'll be going over will be in reference to the interviews that Michael Kovacs has done with Adriano from the YouTube channel Passive Income Investing. I'll use a few snippets from the interviews, but if you want to watch the full videos, I'll link to them in the video description below. A special thanks goes to Adriano for getting us all these details directly from the funds themselves so that we can all get a better understanding of these ETFs. So initially, HHIS will include all of the 9 currently available leveraged products in Harvest's high income shares lineup, and they will more or less be equally weighted in the portfolio with a quarterly rebalancing. The ETF will also have leverage between 20 to 25%. The reason for why it says 20 to 25% leverage is because MSTY and CONY are being included, and they are currently non-leveraged versions. But when they're able to release leveraged versions, they'll definitely replace these two with the leveraged ones. An important detail when it comes to these ETFs, especially with how the Canadian dollar has performed this year, is that all of these are unhedged when it comes to the currency hedging. This means that I'll be exposed to the currency exchange rates when it comes to performance. In this past year, as we've seen the Canadian dollar weaken when compared to the US dollar, this has been a positive impact for stocks or ETFs that are unhedged. This is because it has added an additional 7 to 8% of outperformance when compared to a Canadian dollar hedged stock or ETF. This is explained in more detail in my previous video comparing cover call ETFs and the indexes, so watch that next if you haven't seen it yet. When asked about the future of HHIS and what we can expect, here's what Michael Kovacs had to say from the interview.
And as I mentioned before, we may end up having 15 or 20 of these eventually. We'll probably just limit it somewhere around 15. So we've got the sort of the highest paying income shares on an equal weight basis in the portfolio.
So it looks like the goal here is to attain the highest possible yield with this fund, and they'll only be keeping the highest paying ones within the ETF. The last little bit of detail is distribution frequency, and that'll be on a monthly basis. Though there was also a question asked whether or not there would be a weekly distribution in the future, and this is what the response was.
You know, and we have talked about that. I know there are some firms in the States that have done that or are looking into.
Yeah.
It's a very intense operational administrative side, very costly. And I just can't see that in the cards, at least at this point in time, the way systems are set up. to bring out a weekly distribution. So at this time, it'll remain monthly.
So it seems unlikely we'll be seeing weekly distributions here in Canada anytime soon, or at least until a more efficient way to do weekly distributions is in place. Like all of the other high income shares funds, they use an active covered call writing strategy, where they'll write covered calls on up to 50% of the stock in order to generate the monthly cash distributions. They also apply a modest 25% leverage on them in order to mitigate some of the upside that can be capped with the covered call strategy, and to also generate a higher income. To hear it directly from Harvest, this is how it was outlined.
Well, you're correct. I mean, the minimum is usually around 33%, and then we'll write up to 50%.
Okay.
And they're usually at the money or slightly out of the money, but they're right around that area where you get on a 1 month call. That's where you see your sort of maximum premium levels. So we will continue to write in that level and between 33 and 50%.
So this is good to hear, because if we go by this, it means that typically 2/3 or 66% of the portfolio can participate in the growth when the underlying stock goes up in price appreciation. For some more context on the goals and objectives by Harvest, here's another snippet that gives more insight into their option strategy.
And then, Harvest has a sort of a reputation for trying to deliver consistent yields over the long term. So we're not trying to be the highest paying, but for that point, we want to be competitive out there in the marketplace. But writing at 33 to 35% really gives us a lot of cushion to generate those yields easily. I mean, you can see yields much higher. You could literally double the yields on some of these portfolios if you went right to the max of 50%. But then you give yourself very little wiggle room. If you get into, say, a market drop and then the volatility levels fall apart, you're going to be paying out these big yields that you can't really meet. So we'd rather be in the middle and feel comfortable with those levels, just like we do on our other portfolios.
With all these details, I think we can have confidence in that they have the structures put in place to account for the bad periods, and to ensure that they can keep paying the minimum distributions they set out to achieve within each ETF. The best part of the announcement is that they didn't keep us waiting with what the first distribution amounts would be, and were able to also include it with the news release. All of these will have an ex-dividend date of February 28th and a payable date of March 7th. It's important to keep in mind that this is the initial monthly distribution, and that these newly released ETFs have been noted down as variable distributions. So we have to expect that it could change over time from month to month. I'll talk about this more later on in the video and give some of my own thoughts as to what I think we can expect going forward. For the reaction at the time recording this video, it's currently the third largest fund in terms of AUM for all the high income shares products, and is about to pass LLHE for second place. In first place is NVHE with $75.55 million in AUM, and I'm sure it'll eventually pass it as well. Both LLHE and NVHE were launched at the same time last year in August, so the fact that HHIS has been able to catch up in just 2 weeks is saying something about the interest in this particular fund. In terms of on Blossom Social, just 2 weeks into the launch, it was the 13th most bought stock on the platform in this past week. If you look at the actual list, HHIS is at the very bottom, but if you look at all the other stocks and ETFs above it, none of them are covered called ETFs. So I think after another month or two, HHIS is going to definitely be the largest fund out of all the high income shares products, but it'll still have a long way to go to catch up to the likes of HYLD or USCL and QQCL. Now this is the part which has many of us confused or questioning whether or not to invest, and this is the notion that the distributions have been listed as monthly variable distributions. Here's what was said in the interview.
So on this latest tranche, what we have is a minimum distribution level. And the minimum distribution level is based historically on the volatility, the trading patterns of that stock, the volumes of that stock, and what we can generate comfortably at a 33% rate. So we've set numbers as a minimum level of distribution. And if we're having a fantastic month with volatility and we can pay more, we will pay more. So the idea is to provide that comfort to people to know that, as you said, in the Harvest way, we want to make sure that we've got a minimum level of distribution going out. But if we can pay more, we'll pay more.
So that means at the very bare minimum, even if they had a bad month, they would still be able to distribute the listed minimum amount on each ETF. But in general, it seems like they feel comfortable in being able to pay a higher amount based on the first distributions they've already announced. This is mentioned here in this part of the interview.
So for example, let's look at my notes here on MSTR. The minimum distribution that we've set is 24 cents per month. As you know, with the first distribution declared, it's at 40 cents. So we're very comfortable that we can pay a higher level?
Based on this, we can try to see if this is true if we do some simple math, starting by looking at when these new ETFs were released, which was on January 16th, and then taking the ex-dividend date of February 28th. This would mean that all of them would have approximately 1.5 months to generate income. If we take the minimum distributions from all the new ETFs and then multiply the amounts by 1.5x, all of them except for CONY will return values that are all lower than the initially announced distribution amounts. I'm not sure exactly why CONY is paying less, but maybe they want to be a bit more conservative with that one. So what was mentioned in the interview is more or less correct in that the first distributions are actually higher than what is stated for their minimums. If we then take the first distributions as a potential high mark of the range, we can then reverse the calculation by dividing the values by 1.5x. This will then allow us to establish an estimated range for the distributions going forward. Now this is just me trying to make sense of all the information, so don't take these as concrete values. I could be entirely wrong, but I think it's an educated guess of what we can expect going forward in future distributions. All of these values will be based on the initial $12 inception price, so they won't be 100% accurate since some of these have moved up or moved down in price since then. So for MSTY, we can expect a projected distribution amount between 24 cents and 27 cents, or roughly a 24% to 27% yield. For CONY, we can expect a distribution amount between 20 cents and 22 cents, or roughly a 20% to 22% yield. For Palantir, we can expect a distribution amount between 15 cents and 25 cents, or roughly a 15 to 25% yield. For Tesla, we can expect a distribution amount between 17 cents and 21 cents, or roughly a 17 to 21% yield. For METE, we can expect a distribution amount between 12 cents and 13 cents, or roughly a 12 to 13% yield. Then finally, for HHIS, we can expect a distribution amount between 16 cents and 17 cents, or roughly a 16 to 17% yield. So when looking at these ranges now, there's sort of a far cry from the initial distribution amounts and yields. I would happily like to be wrong in this and that they can continue with the initial amounts or yields, but I think these do make more sense and would be more realistic going forward. But I also want to make sure and point out that this again is only based on the first distribution amounts and what they can comfortably feel they could generate for distributions. It can also very well be even higher once the funds find their footing, and it can also change based on the performances of the underlying. In a separate interview, Michael Kovacs talks about the history with Harvest's other funds and how might the distributions change depending on various factors.
So when you think about HTA, our tech achievers, we've increased that 5 times now since we've started that fund, once fairly recently. And what happens in a scenario like that, and it would be the same with these stock ETFs, if this price is rising generally over time, and our right level to meet that commitment is actually dropping. So say we said 33%, but let's say, I'm just gonna throw a number, 6 months from now, we're writing at 25%. We could probably increase that right level and bump that yield higher. So it's really a matter of if that stock is slowly moving higher over time and our right level declines, that allows us to generate higher yields by writing more or increasing the yield. So the opposite, and this is probably more what people have to think about, is there's really, for yields to be cut, there's a few different things that have to happen. Number one, won't name any particular stock name, but let's say a stock drops considerably, like 33, 35, 40%. But if it rebounds back up quickly, you're fine. But if it drops and then stays down, what happens is your volatility levels start to drop. And more than the price of so more than the price of the fund moving around, but to cut the yield, you'd have to see the volatility levels drop and remain low for a large period of time. And in that case, you've got two things working against you. And if that were the case, we would have to cut the yield. We're fortunate that we haven't had to do that, but you never know what's going to happen in the markets. But so there is a scenario where prices fall, they stay down, and volatility flattens out. Then you're probably going to be forced to cut the yield. If you can take your yield that you're writing up to 50% and still meet that, then you're okay. But if it falls that much, and that's considerable, and stays there, that would lead to a yield cut.
So because all of these are definitely high growth companies, the distributions over time do have a high probability of increasing as well with the underlying stocks. A prime example of this is actually from Purpose Investments NVIDIA ETF, which launched last year with the ticker symbol YNVD. If we look at it on dividend history, you can see since the fund's inception, they raised the dividend a total of 6 times. That equates to a 341.18% increase from the starting 17 cents to the 75 cents they are paying now. And this is because NVIDIA's stock price has gone up 130% since the inception date. So hopefully this all made sense and gives everyone a clearer picture of what to expect in the future. I've tried to give as many perspectives and references as I can so that you can make your own decision on the future distributions from this ETF. Let me know in the comment section below if you think this math checks out and what you think the distributions will look like after the first one in March. So overall, I think this is a very solid introduction and new option for income investors, and has definitely upped the competition in the area of single stock ETFs in Canada. The stock selection mix within HHIS is uniquely curated with a set of large cap companies from diverse sectors, and with all strong potential for future growth in the coming years ahead. And over time, when they release more new high income shares products, we can expect them to also be included in the ETF for more diversification. Two of which we already know will eventually be the leveraged versions of MSTY and CONY, which in turn will definitely lead to an increase in the distribution yield. There's just one more comment that I also want to say and point out, and that's the risk rating for HHIS is set to high. And that's because of the nature of some of these holdings, and the objective of this fund in itself is to harvest the highest amount of income from the volatility of the underlying stocks. So while there is some diversification by holding the basket of all the stocks, you do want to make sure that you can handle some of the potential volatility that comes with investing in this product. I'm personally invested in a few of the single stock names, and I've also started a position in HHIS on its first day since being listed. While these definitely won't be core positions in the sense of making up half my portfolio like USCL or QQCL, I do plan on having HHIS being moderately sized somewhere in between. If you enjoy this type of content and would like to follow for more, it would be appreciated if you can give the video a thumbs up and also subscribe to help out the channel. My goal for YouTube this year is to reach 1,000 subscribers, and we're currently now at 681. Thanks to everyone who has subscribed so far, and with that I'll see you in the next video.